You saved in the 401k, you waited to claim, you give to your church every December. 3 right moves. All of it exactly what you were told to do. Done in the wrong year. Any one of them hands money to the IRS that you never owed. Not because you saved too little, because of when you touched it. 7 of these, counting down. Number 1 has a deadline, and it isn't April. There's a reason these stay invisible for so long. All 7 are about timing. The amount you saved never enters into it. The same dollar, moved in a different year, can cost nothing at all. Move it in the wrong year, and it drags 2 or 3 other numbers up behind it. Numbers that live on a completely different form and don't show up until much later. That's why Save More never fixes any of this. There was never anything wrong with the saving. Start with the smallest one because it's the easiest to undo. You're 72, you give $2,000 a year to your church and you write it from your checking account, the way you have for 40 years. That money already passed through your income on the way out of the IRA. There's a second door. It's called a qualified charitable distribution. The money goes straight from your IRA to the charity and never touches your income at all. The IRS wording is that it is, quote, not includable in gross income. 2 conditions. You have to be at least 70 and a half on the day it goes out. And for 2026, there's a ceiling, $111,000 a year. Same $2,000, same church. One version shows up in your income. The other one doesn't. Hold on to that idea. Income you never report. It comes back 4 more times before this list is over. In 2025, a new deduction arrived for people 65 and older, $6,000 per eligible person. It got reported everywhere as the end of taxes on Social Security. It isn't. The Congressional Research Service says it flatly. The calculation of taxable Social Security benefits, quote, remains unchanged. The deduction sits in a different section of the tax code entirely. It lowers the tax on your income. It does not change how much of your benefit counts as income in the first place. 2 things about it that rarely get said out loud. It has an expiration date, tax years 2025 through 2028, 4 years. And it shrinks. For every dollar your income goes above $75,000, $150,000 for a couple, you lose 6 cents of it. A couple with 2 eligible people is looking at $12,000. It's gone entirely by $350,000, which matters enormously for number 5. You bought it in 1978. You're selling it now. The IRS lets a couple exclude up to $500,000 of the gain, $250,000 if you're single. For most people, that's the whole thing and nothing happens. But if the gain runs past the exclusion, the rest is reportable income. And reportable income doesn't stay in one place. It lands in your adjusted gross income. Your adjusted gross income is most of what Medicare calls modified adjusted gross income. MAGI for short. That's the number Medicare watches. So one signature on one afternoon can raise your Medicare premium, shrink the $6,000 deduction from number 6, and change how much of your Social Security is taxable. 3 separate bills from one sale. And the Medicare part doesn't arrive this year. Hold that thought. It comes back at number 2. This one costs the most, and it shows up the latest, after one of you is gone. Say the husband earned more. He claims at 62 instead of waiting. His own check is smaller for life. Most people know that part and accept it. Here's what doesn't get explained. When he dies, her survivor benefit is measured against his reduced check, not against what he would have had. The regulation is specific. Her benefit is set at what he would be receiving if he were alive, quote, or 82.5% of his primary insurance amount, whichever is larger. Primary insurance amount is the full check he'd have had at his normal retirement age. So there's a floor as long as she waits until her own full retirement age. She can't drop below 82.5% of his. Claim before that, and her own reduction comes off on top of his. But there's also a ceiling, and he set it decades earlier on a form he filled out at 62. The decision belongs to one person. The consequence belongs to the one who outlives them. Now the pattern breaker. Number 3 is on this list because it's the one people get wrong in the other direction. You're 64, still working part-time, and someone tells you that if you earn too much, Social Security takes your money. For 2026, the exempt amount below full retirement age is $24,480. Above that, Social Security withholds $1 for every 2 you earn. In the year you actually reach full retirement age, the limit jumps to $65,160, and it's $1 for every 3. That's real. Money does stop arriving. But read what Social Security says happens next. Quote, once you reach normal retirement age, your monthly benefit will be increased permanently to account for the months in which benefits were withheld. Permanently. That's a delay. The money is held, then paid back to you through a higher check for the rest of your life. People quit jobs over this rule. They quit over the half they were told. That's the only good news on this list. The last 2 cost real money. Roth conversions are ordinary planning. You move money out of a traditional IRA, pay the tax now, and it grows tax-free after that. Nothing about that is a trick. The trap is the calendar. Medicare charges higher income households a surcharge on their premiums. The official name is the income-related monthly adjustment amount. Everyone calls it IRMAA, and Medicare doesn't look at this year. Social Security's own page to set your 2026 amount. Quote, we use your most recent federal tax return the IRS provides to us. Generally, this information is from a tax return filed in 2025 for tax year 2024. 2 years back, a big conversion in the spring of 2024 produces a letter in the winter of 2026 when the conversion is long finished, and nobody connects the two. The standard Part B premium for 2026 is $202.90. Cross the first line for a couple, $218,000, and it's $81.20 more each month, plus $14.50 on the drug coverage, $95.70 a month per person. For a couple, $2,296.80 in a single year. One form exists for this. It's called SSA 44, and it's for a life-changing event. Retiring, a spouse dying, not for a conversion you chose. Which brings us to the one at the top. This is the biggest, and it's the one almost nobody sees coming because it works backwards from how taxes normally work. Social Security gets taxed on a sliding scale, and the slide depends on something called provisional income. That's your adjusted gross income plus tax-exempt interest plus half your Social Security. Meet Ray and Dolores, both 67, both hypothetical. Between them, they collect $44,586 a year in Social Security. That's two average benefits. And Ray has a small pension, $20,000 a year. Add half their Social Security to that pension, and their provisional income is $42,293. That puts $5,147 of their benefit into their income. Their deductions cover all of it. They owe no federal income tax. Now the same couple takes $25,000 out of the IRA. Roof repair, one withdrawal, 1 year. Provisional income becomes $67,293, and the taxable part of their Social Security jumps from $5,147 to $25,799. Read that again. They pulled out $25,000. On top of it, $20,652 of their own benefit got dragged in behind it. Their taxable income went from $0 to $23,099. They didn't get a raise. Social Security didn't change. They pulled from their own savings, and the withdrawal reached over and pulled their benefit in behind it. And the reason it keeps happening to more people every year is one sentence from the Congressional Research Service. Quote, "None of the thresholds is indexed for inflation or wage growth." 25,000 and 32,000, written in the 1980s, never moved since. Your benefit rises with the cost of living every January. The line it has to stay under does not. So, the deadline. Every single one of these is settled by a calendar year, not by your income, not by how much you have, by which 12 months the money moved in, which means the door doesn't close in April when you file. April is when you find out. The door closes on December 31st. A withdrawal split across 2 Decembers instead of one. A conversion sized against a line instead of a hunch. A donation that leaves from one account instead of another. None of that requires more money. It requires knowing which year you're standing in. You didn't save too little. You were just never told that the calendar counts. One thing worth doing tonight, and it's free. Find last year's tax return and look at one line. Adjusted gross income. That single number is what Medicare, the deduction, and your benefit are all measured against. If one of the 7 surprised you, say which one in the comments. And subscribe if you'd rather meet these rules here than in an envelope.